Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors.
In this case, at the end of the day, though, what we've done is rather than making $1.44, which would be on a $3.56 risk, what we've done is we made $1.69, and thanks for catching that, or $1.39. Thanks for catching that, Sal. We've made $1.39 on a $2.61 risk. So you can compare the apples to apples here with respect to the two strategies. When we're looking at it on the other side of the transaction, again, we need to make an adjustment for that particular profit here, but you can see that essentially our call options will expire worthless, our put options expire in the money, our net profit is essentially the same, and in the case of the strangle, we're looking at a similar scenario where the call options expire, put options have that $4 intrinsic value simply because we take the 104 strike put, subtract the value of the underlying pair value, and we get $4. Now again, this needs to be the $1 instead of the $2. So once again, I apologize for that. But the idea is that you can now get a comparison as to how those two strategies would work based on the same move in the underlying security. Now, in the case of the straddle, Sal's quick with his math today, which is great. Straddle produces a 40% return versus the strangle, which is 53% turn, and that all has to do with the risk exposure created by the lowered risk exposure of the strangle. And that really is the objective of any trader. How can I lower my risk exposure and maximize my profitability? And so there you have it. Now, what are our considerations here? Well, first of all, a strangle at or close to the money will require less of a move to profit. So in other words, if we created that straddle, although on expiration, based on the example we just created, we see that it cost us a little more, and we, based on the cost of the position, our rate of return was a little less. If we were looking to capture a move very quickly and not hold until expiration, then ultimately a straddle, the 105 call option will begin to profit very quickly as the security moves up, and of course the put option will begin to profit very quickly if the underlying moves down. So typically a straddle will profit much more quickly and require less of a move to profit over and above a strangle. The strangles are less expensive but require a larger move in the underlying security, typically to recognize that profit if you're looking to capitalize on that over a shorter time frame. Benefit of the strangle, as I illustrated, is that there is the ability to adjust your strike prices in order to capitalize on a directional bias. And finally, what we really need to make sure is that the underlying volatility, so the historic volatility of the pair value, is sufficient enough to compensate for the cost of the position. So I want to be looking at the CDD, for example, and be looking at the last couple of months of trading activity and price activity on the CDD, and say, okay, is there the ability for the CDD to move 5 points over the next couple of months? And if the answer is yes, well then I recognize that, okay, well then there is the ability for me to be profitable on this transaction if I have to hold until expiration. So we want to make sure that the underlying has sufficient enough movement on a day-to-day basis to compensate for the cost of the position. Now, let's talk a little bit about applying a short strangle. Now, this is essentially a strategy whereby we expect the pair value to stay range bound. And what we're looking at doing is taking advantage of implied volatility when it's significantly high. So whereas the long straddle and the long strangle is essentially a strategy that we're looking to take advantage of low volatility and capitalizing on an expansion in volatility, with the short strangle, we want to look at options that are particularly high from an implied volatility perspective, and we want to take advantage of a volatility crash or a depreciation in the implied volatility on the option contract. Typically, these strategies, this particular strategy, would be implemented based on a short-term outlook, simply because we're also putting the idea of time depreciation in our favor. So the faster these options can expire, the faster we can actually look to generate a profit through the expiration of the two option contracts. The objective here is, of course, to receive a credit for selling both the call and the put option, and then realizing our full profit when the call and the put options expire on the third Friday of the expiration date. The drawback to this particular strategy is that the investor is going to be required to put up a margin, because if you think about it, both the call option and the put option short positions are naked short positions, and your broker is going to say, okay, if you want to sell these options short, you need to have enough capital in your account to cover your margin requirements. So if we take a look at an implied volatility chart here on the CDD, and we look at that for considering whether or not it's appropriate to apply a short strangle here, we can see that this would be an ideal time to sell those option contracts. You can see that the implied volatility is illustrated in blue, historic volatility is in red. You can see that implied volatility is high, suggesting that option premiums are high, and that means that when we sell those option contracts, we're going to be able to enjoy collecting a fairly decent premium. Now you can see that on a day-to-day basis, the implied volatility in fact dropped quite significantly. So our objective would be to sell the option premiums when implied volatility is high, make sure that we're selecting option contracts that are ideally outside of the range of the pair value within that particular time frame, and then capitalize on this crash in volatility and ideally the consolidation of this pair value within a particular range. You can see how that implied volatility versus historical volatility comparison, you can see how that, or relationship, you can see how that compares to implied versus historic right now. So just to give you an idea as to what we would be rationalizing, or how we might look to determine whether or not, and this is really going back, John, or not John, sorry, Stephen, to answer your question, is ideally right in here would be a perfect time to create a straddle or a strangle, where implied volatility and historic volatility are seemingly close to one another, and then capitalize on that expansion in volatility plus that move in the underlying security. This is what we'd be looking at creating right now. Implied and historic relatively close, stock relatively range bound, and we want to see a break out of that particular range, looking to take advantage of a move higher or lower in the pair, plus an expansion in volatility.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.